All right, let's dive into one of the most powerful forces in any economy, the monopoly. It's basically the exact opposite of what you'd call perfect competition. We're talking about a market where one single firm, well, it pretty much calls all the shots. I mean, have you ever been in a situation where you need to buy something or get a service and you realize there's only one company to go to? Like, you literally have no other choice. Yep, that feeling, that's the power of a monopoly in a nutshell. And it's exactly what we're going to unpack today.
So, here's the game plan for this explainer. First, we'll nail down what a monopoly actually is. Then, we'll look at its blueprint, what makes it tick. After that, we'll get into the juicy stuff. Its power over prices, the big debate over whether these giants are good or bad, and finally, how we try to keep them in check.
Okay, so let's get right to it. What exactly is a monopoly? Let's break it down and get a really clear definition.
So, here's the core idea. You've got one single, dominant company running the show in an entire market. They control the whole supply of something unique, and there are no good alternatives. So if you want that thing, you've pretty much got to go to them. There's nowhere else to turn. Now, when you hear dominant, you might be thinking, oh, they must own 100% of the market, right? But actually, the bar can be way lower than you'd think. In the UK, for instance, a company is often considered a monopoly if it has more than just 25% of the market share. Yeah, just a quarter. That's a surprisingly low threshold for having that much clout. So it doesn't matter what industry we're talking about, tech, utilities, you name it. Every monopoly is kind of built from the same blueprint. They all share these 4 key features that are the source of all their power. Okay, so first up, you have just one seller. Think about something like Thames Water. They're the only game in town for water supply for millions of people. Second, and this is a big one, there are super high barriers to entry. It's incredibly hard for anyone else to jump in. We're talking about things like patents that legally block competitors, or just the mind-boggling cost of, say, building a whole new railway network. Third, the product is unique. There are no close substitutes. And all of this leads to the fourth and honestly the most critical piece of the puzzle, the power to set their own prices. And that right there, the power to set prices, is where things get really interesting. This is the biggest weapon in a monopoly's arsenal. It's where their market power truly shines, and it's definitely where you and I, as consumers, feel the impact the most. See, in a normal, competitive market, companies are what we call price takers. They just have to accept the going rate, the market price. They have no choice. But a monopoly? Ooh, that's a whole different story. They are a price maker. They don't just take the price, they get to set it, influencing it to make as much profit as possible. So, what's the bottom line for us? Well, it's pretty simple, and it's not great news. A monopoly will almost always produce less of something and charge a higher price for it than you'd see in a competitive market. And this allows them to rake in what economists call supernormal profits. We're not just talking about a good year, we're talking about massive, long-term profits that go way beyond what they need to just stay in business. Okay, so this all leads to the big central question, doesn't it? Are these powerful giants just bad for everyone? Or is there maybe a silver lining, a hidden upside to having them around? Let's take a look at both sides of that coin. I mean, it's so easy to just label them the villain of the story, right? But is it always that black and white? Let's actually dig into the case for monopolies, because believe it or not, there are some pretty compelling arguments. All right, so on the pro side, their massive size can lead to something called economies of scale. Basically, they can produce stuff so efficiently that their average cost per item is super low. And remember those huge profits we mentioned? Well, they can pour all that cash into research and development, funding absolutely game-changing innovations. I mean, think about Bell Labs. It was funded by the AT&T telephone monopoly, and they invented the transistor, the very thing that's the backbone of all modern electronics. Plus, in certain cases, having just one provider means a stable supply, and you don't waste a ton of money building the same thing over and over again. But of course, there's a flip side. A pretty big flip side, actually. The case against monopolies is powerful. The biggest one, for sure, is that we, the consumers, end up facing higher prices and having way fewer choices. And without any competition to keep them on their toes, they can get lazy and inefficient, letting costs get bloated. And then there's the constant danger that they'll just abuse their power, exploiting customers or just swallowing up any small competitor that dares to challenge them.
So, with all these potential downsides, it's pretty clear we can't just let monopolies do whatever they want, right? And that's exactly where governments and regulators step into the picture. Their job is to try and balance the scales and look out for us, the consumers.
And this isn't just a theory. To make it super concrete, let's look at the UK. They have a specific watchdog called the Competition and Markets Authority, the CMA. And their entire reason for existing is to keep an eye on these big companies and make sure they're not crossing the line and abusing their power.
And they've got a whole toolkit to get the job done. For example, they can slap price caps on essential stuff like water and energy just to stop prices from going through the roof. They also investigate huge mergers to stop one company from getting too big and powerful. Really, their whole goal is just to keep the playing field as fair as it can be.
This brings up a really crucial point. Sometimes, and this might sound weird, a monopoly is actually the most efficient way to do things. Just think about it for a second. Does it make any sense to have 3 different companies all digging up the streets to lay their own separate water pipes to your house? Of course not. That would be a chaotic and incredibly wasteful mess. These are what we call natural monopolies. And for these, the answer isn't to break them up, but to regulate them really carefully, like what's done with Network Rail in the UK. So when you boil it all down, here's the key takeaway. Monopolies are all about a fundamental trade-off. On one side, you have the potential for massive efficiency and incredible innovation that only comes with huge scale. But on the other side, you've got the very real danger of higher prices, less choice, and companies taking advantage of us. And the whole challenge really is just trying to find that perfect balance.
And that really leaves us with a big question to chew on. In our super complex global economy, what's actually better? A marketplace filled with tons of small, scrappy competitors all fighting it out? Or is it sometimes better to have one massive, but really well-regulated giant running the show? Honestly, there's no easy answer to that one. Thanks for joining me for this explainer.